For the last half century, we have benefited enormously by the fact that there's one international currency, money. It's the US dollar. It's as good as gold because it literally functions like gold. That's over.
He calls it over. I call it a liquidation sale.
Ukraine simply speeds up the process. China, Russia, now Saudi Arabia, Iran, Venezuela, and many more countries are signing up for another international currency.
Welcome back to the Dossier. Professor Wolff is a brilliant mind. His diagnosis of the American empire's decline is accurate. He saw the geopolitical shift. He saw the BRICS nations rising. He saw the loss of trust. But that analysis is missing the most critical variable of 2026. The one variable that turns a slow, manageable decline into an immediate, catastrophic crash. He didn't account for the betrayal of America's oldest economic ally. He didn't account for Japan. While the media distracts you with spy balloons and political theater in Washington, something broke in Tokyo this week. A mechanism has been triggered that makes the 2008 financial crisis look like a dress rehearsal. Today, we are going to dissect the autopsy of the US dollar, not with theories, but with math. To understand why your savings are in danger, you have to understand who actually owns America. It's not China. China's been selling US debt for years. The real owner is Japan. They hold over $1.1 trillion in US Treasuries. For 40 years, this was a symbiotic relationship. Japan exported cars and electronics to the US, received dollars in exchange, and recycled those dollars back into buying US government debt. It was the engine that kept American interest rates low and the American consumer spending. But the engine has seized. The Japanese yen is currently in a freefall. It is crashing to levels we haven't seen in decades. The cost of energy and food in Japan is skyrocketing. Their population is aging, their economy is stagnant, and their currency is becoming worthless. Look at the headlines from this week. Japan going solo on yen intervention. Do you know what that means in plain English? It means they are desperate. The Bank of Japan has run out of options. To save their own currency from hyperinflation, they have to repatriate their money. They have to sell their foreign assets to buy back the yen. And their biggest foreign asset is US debt. This is what we call a forced liquidation event. Japan doesn't want to sell. They have to sell to survive, and here's the trap. If Japan dumps $1 trillion of bonds onto the market, the price of those bonds collapses. When bond prices fall, yields, or interest rates, spike. We are talking about US interest rates hitting 6%, 7%, maybe 8%. At those rates, the United States government is mathematically insolvent. You might be thinking, I don't own government bonds, why do I care? Because the US 10-year Treasury is the benchmark for everything in your life. Your mortgage rate, it's pegged to the 10-year. Your car loan, pegged to the 10-year. Your credit card interest, pegged to the 10-year. If Japan sells, rates in America explode. We are looking at mortgage rates hitting 10% or 12%. The housing market freezes overnight. Corporate debt, which needs to be refinanced this year, becomes unaffordable. Zombie companies, businesses that only survive on cheap debt, will go bankrupt in waves. This is the Japan trap. The US Federal Reserve loses control of the price of money. They can't lower rates if the biggest holder of debt is selling. They are helpless. This brings us back to Professor Wolff's warning. That's over, he said. He was referring to the global trust in the dollar. While Japan sells out of desperation, the rest of the world is selling out of strategy. The weaponization of the dollar against Russia in 2022 sent a chill down the spine of every central banker in the global south. Look at the data. Global gold demand just hit an all-time high. China is dumping dollars to buy gold. Poland is buying gold. Singapore is buying gold. Even Saudi Arabia is signaling they are open to trading oil in other currencies. They are building a lifeboat. The BRICS nations are creating a parallel financial system that doesn't require the US dollar to function. So you have the biggest ally, Japan, selling, and the biggest rivals, China/Russia, leaving. Who is left to buy the debt? Who funds the American deficit? There's only one buyer left, the Federal Reserve. This is the endgame. To prevent the US government from defaulting on its own debt, the Fed will be forced to print the money to buy the bonds that Japan is selling. Analysts are already predicting it. Resumption of Fed buying. They use polite terms like yield curve control or liquidity injection. But let's call it what it is: currency debasement. Trillions of new dollars created out of thin air, flooding into a system where supply is shrinking. You think inflation was bad in 2022? You haven't seen anything yet. We are staring down the barrel of a lost decade. Stagflation. High prices, low growth, and a currency that loses purchasing power every single month. The government gets to wipe out its debt by inflating it away. But you get wiped out at the grocery store, you get wiped out at the gas pump. Your savings account becomes a melting ice cube. So what is the play? How do you survive when the reserve currency burns? History gives us the answer. When fiat money dies, value returns to the physical, to the scarce. You don't hold paper, you hold assets: gold, silver, productive land, Bitcoin, energy, things they cannot print, things that cannot be devalued by a bureaucrat in Washington or a panic in Tokyo. The window to position yourself is closing. The headlines are already out there, screaming the truth for anyone willing to read them. Most people will ignore this video. They will wait until CNN tells them it's a crisis. By then, the exits will be closed. Don't be most people. If you want to decode the economic warfare before it destroys your net worth, make sure you are subscribed to this channel. Here, we don't trade hope, we trade intelligence. I'll see you in the next briefing.